Okay, let's unpack this. We're doing a deep dive today into one of the most essential, yet I think surprisingly complex financial instruments in the American savings landscape,
Hmm.
the individual retirement account, or IRA.
It's an interesting beast for sure. On the surface, it seems so simple. It's just a tax-advantaged box to save money for retirement.
Right.
But the legislation that governs it, I mean, it covers everything from who can contribute to what happens when you die. It is incredibly specific and often uh, pretty counterintuitive.
Our mission today is pretty straightforward. We want to give you the shortcut to being well-informed. We're going to try to cut through some of that confusion, understand the different flavors of IRAs, where their tax advantages truly lie, and maybe most importantly, we're going to look at the surprising things you can and cannot invest in, how you take the money out, and what happens when creditors try to get in.
Yeah, and we've pulled together a really comprehensive set of sources for this. We're going from the basic foundational definition right through to Supreme Court rulings on bankruptcy and some truly mind-boggling statistics on wealth concentration that these accounts can enable.
So let's start right there with the core definition.
Yeah.
What exactly is an IRA?
At its heart, an IRA is a trust. It's an arrangement that financial institutions offer, and it's designed specifically to hold investment assets.
A trust. Okay.
Right. And crucially, these assets have to be purchased using a taxpayer's earned income, so money they've made from working. And it's all designated for that person's benefit later in life. The whole point is the tax advantage, allowing those assets to grow without being taxed immediately.
And here's a quick nugget of insight right off the bat before we get into the mechanics. Most people, myself included, when we say IRA, we think of the account itself.
That's natural, yeah. But the IRS, specifically in its guidance, like Publication 590, they clarify the terminology. The IRA, the individual retirement account, is technically just one type of individual retirement arrangement.
Oh, okay.
It's the most common type by far. But that umbrella term also covers other, less common things, like individual retirement annuities and certain employer-established trusts. So when we talk about the IRA, we're really talking about the star player in a much larger family of arrangements.
That distinction is important for context. Now let's jump into the core choice that every single saver has to make. This is the one that determines the entire tax future of their savings. This is the difference that most people, rightly so, focus on first.
The traditional versus Roth debate. It's fundamental, and it all boils down to a single question. When do you want to pay tax on this money?
Right. Now or later.
Exactly. Do you want the break now or do you want the break later? And that decision can shape your financial life for decades.
Well, let's start with the traditional IRA. It's the historical standard, right?
Yeah.
The elder statesman of retirement savings.
It is. The traditional IRA came out of some landmark legislation back in 1974. And initially, it was pretty restrictive. It was designed specifically for self-employed people or for workers who didn't have access to a retirement plan through their employer.
So it started as a way to kind of create parity for the unprotected worker.
Precisely. And its key function was, and still is, tax deferral. The contributions you make are mostly tax-deductible. You put the money in, you immediately reduce your taxable income for today, and you get an upfront tax break.
And then the money grows inside, and you don't pay taxes on, dividends or capital gains year to year.
That's the deferral mechanism at work. All those transactions inside the IRA are shielded from tax.
But that deferral doesn't last forever.
No, the government only defers the tax. It doesn't forgive it. When you eventually withdraw those funds in retirement, those withdrawals are taxed as ordinary income, just like a paycheck.
Which makes the traditional IRA a great choice if you think you'll be in a lower tax bracket in retirement than you are right now during your high-earning years.
That's the classic calculation, yeah.
Now, what really changed the landscape was legislation in the early 80s. This feels like an example of Congress seeing a good idea and just making it available to everyone.
That's right. Starting in 1981, they dramatically expanded the scope of the traditional IRA. They opened it up to all taxpayers. Didn't matter if you had an employer plan or not. It was a massive democratization of access.
But there's a catch there, right?
There is. It's important to note that later legislation scaled back that universal deductibility for higher earners who also had employer plans, so they introduced all this complexity around income thresholds. But the account itself, the ability to open one, became accessible to everyone.
Which brings us to the newcomer on the block. The Roth IRA. Here, the tax calculation is completely flipped, and it's why the Roth is often so appealing, especially for younger savers.
The Roth is a mirror image. The contributions are strictly non-deductible.
So post-tax dollars.
Post-tax, money you've already paid tax on. You get absolutely no tax break today. But the incentive for paying that tax up front is, well, it's unparalleled. The growth inside the account is entirely tax-free.
And the really crucial benefit, the thing that makes the Roth so flexible.
The earnings can be withdrawn completely tax-free in retirement as long as you meet a few basic requirements on age and how long the account has been open. But here's the major liquidity point. The original contributions, what we call the basis, can be pulled out at any time.
Any time without penalty.
At any time without penalty or tax. This flexibility is what makes the Roth structure feel like a hybrid savings and emergency fund vehicle.
And just to clear up a common misunderstanding, Roth is not an acronym.
No, it's not. It was established in 1997, and it was simply named after its champion, Senator William V. Roth, Jr. of Delaware. It's just a surname, not some secret code.
So before we get to the funding rules, let's just briefly clarify those other more specialized IRA types that you sometimes hear about, usually for businesses.
Sure. The first one is the SEP IRA. That stands for Simplified Employee Pension. This is used by small business owners or self-employed folks to make contributions directly to an employee's traditional IRA or their own. It's popular because it has a really low administrative burden compared to setting up a 401k.
And then there's the one that kind of forces the employer to step up.
That would be the Simple IRA, the Savings Incentive Match Plan for employees. It's structurally a bit closer to a 401k, but like the name says, it's designed for simplicity. The key feature is that it requires employer matching contributions when an employee contributes.
So it's not optional.
Right. Although the overall contribution limits are typically a bit lower than a full 401k.
And finally, a little footnote in history, the MyRA.
The MyRA. Yeah, that was a short-lived federal initiative from 2014. It was aimed at entry-level savers who didn't have workplace plans. It used the Roth structure, but it was super conservative. It could only invest in government bonds.
And it didn't last long.
No, it was phased out in 2017. It really just illustrates how difficult it is for the government to make these complex arrangements accessible at the lowest tier of saving.
So whether you've picked the traditional path for today's tax break or the Roth path for tax-free growth tomorrow, you've picked your structure. Now we have to talk about the really uncompromising rules of the game. Funding and limits.
This is where the IRS gets very, very particular. There are strict rules on how much money you can put in and, critically, what kind of money is even eligible to fund these accounts. And it's important to appreciate the history here because the limits have grown a lot over time.
Yeah, looking at the history of the limits really shows how the government's thinking on this has evolved.
When IRAs were introduced back in '74, the maximum was, a very modest $1,500, and that low cap stayed in place for 7 years.
$1,500, wow.
Yeah. After the rules opened up to everyone in the early '80s, the limit went up to $2,000, and it just held steady there for 2 decades.
And then, starting in the early 2000s, things started to climb a lot more rapidly. We went from $2,000 to $3,000, then it hit $5,500 by 2013.
That rapid increase reflects rising costs and the realization that, $2,000 just wasn't going to cut it for a full retirement. For this year, 2024, the maximum contribution limit is at $7,000. It's the government trying to keep pace.
And Congress also realized that older workers, maybe people who started late, needed a way to supercharge their savings.
Absolutely. That's the whole purpose of the catch-up contribution. It was introduced in 2002. It allows anyone over the age of 50 to contribute an extra amount. Currently, it's set at $1,000, right on top of that standard limit. It's a key benefit designed to mitigate the effects of lost time.
Now, a critical point that trips a lot of people up. This limit is across the board, right?
Correct. That maximum allowable contribution, the $7,000 for 2024, that applies to the total you put into all of your traditional and Roth IRAs combined for that year. You can split it however you want, all in a Roth, half and half, but you cannot go over that total limit.
And we have to circle back to the complexity around the traditional IRA deduction, which is tied to whether you have a plan at work.
This is the nuance that makes the traditional IRA less simple than it sounds. If you, or even your spouse, are covered by a retirement plan at work, like a 401k, the tax deduction for your traditional IRA contributions starts to phase out once your income crosses certain thresholds.
So a high earner might contribute to a traditional IRA but get no tax deduction for it at all.
Exactly. You have to check the tables in the IRS publication based on your filing status every single year.
Which brings us to the strictest rule of all, eligibility. What money can actually go into this tax-advantaged box? The sources are crystal clear. Only taxable compensation is allowed.
This is a vital gatekeeper rule. Taxable compensation is income you earn from working, so wages, salaries, commissions, self-employment income, and even taxable alimony. If the money didn't come from you working, the IRS doesn't want it in an IRA.
Which means there's a very specific list of income types that are strictly excluded.
Oh, absolutely. Take unearned taxable income. If you made, say, $10,000 from stock dividends in your regular brokerage account, you can't just take that $10,000 and stick it in your IRA. It's investment income. It's not compensation.
And what about tax-exempt income? Most of that is out too, but there's one big exception.
Correct. Most tax-exempt income is ineligible, but the IRS makes a specific allowance for military combat pay. Even though that income is tax-exempt, it is eligible to be contributed to an IRA. It's a recognition of the unique circumstances of service members.
What about payments that people really rely on, like Social Security or child support?
Social Security is strictly ineligible. Doesn't matter if you pay tax on it or not. It is not considered earned income. Same with child support payments you receive, explicitly ineligible.
Okay, I get the logic behind excluding unearned income, but why are the rules so strict about cash versus assets? The sources make it clear you can only fund an IRA with cash or cash equivalents.
This rule is essential to maintaining the integrity of the whole system. The IRS needs a clear, verifiable value for the contribution. If you are allowed to contribute assets, say a stock or a rare stamp, you'd have to establish a fair market value for it. And that just opens the door to abuse, where people could intentionally overvalue assets to get a bigger tax deduction.
So if I have $7,000 worth of some crypto in my personal account, I can't just transfer that crypto into my new IRA.
You absolutely cannot. You would have to sell the crypto first, realize the gain or loss on it, deposit the $7,000 in cash into the IRA, and then use that cash to buy whatever you want inside the IRA.
And if you try to transfer the asset directly,
That is a severe violation. It's called a prohibited transaction, and it immediately jeopardizes the entire beneficial tax treatment of the fund. It's a massive risk for a simple shortcut.
wow, okay, so that's why the custodian's role is so critical.
They're
The
l-
gatekeepers.
They are. They're typically banks, brokerage firms, credit unions. They handle the compliance and hold the assets. But it is so important to remember what our sources stressed here. The IRS explicitly states that custodians and administrators cannot provide investment advice. They facilitate the structure, they do not guide the decisions, and that distinction is key, especially as we move into the more exotic investment options.
That is the perfect segue. For most people, an IRA is pretty conservative. But once you move into the self-directed world, the rules of what you can invest in become fascinating, and the potential pitfalls just multiply. Here's where it gets really interesting. Because while, 99% of people use their IRA to hold mutual funds or ETFs, a dedicated minority uses these specialized custodians to unlock a huge and often surprising array of alternative investments.
We're talking about the self-directed IRA. That's where the custodian is willing to administer assets that fall way outside the traditional world of stocks and bonds.
So what kind of assets are we talking about here? What suddenly becomes available?
Almost anything that isn't explicitly prohibited by the Internal Revenue Code. This includes physical real estate like actual rental properties or raw land. It includes private mortgages where the IRA acts as the lender.
The IRA can be the bank.
It can be the bank. It also includes private company stock, oil and gas limited partnerships, even intellectual property. Our sources also note precious metals are allowed as long as they meet specific fineness standards.
It really sounds like the IRA is acting like its own independent investment trust at that point.
It is, but, and this is a big but, most common custodians, your Vanguards, your Fidelities, they won't touch assets like real estate. They limit you to traditional brokerage assets. If you want to hold an actual house in your IRA, you need a specialized self-directed custodian who is equipped to handle the unique valuation and compliance issues.
Let's nail down the list of assets that the IRC strictly prohibits, no matter what the custodian is willing to do.
The law prohibits specific assets known as collectibles. The list includes things like art, stamps, antiques, rare coins, with a few exceptions for government-minted coins, baseball cards, and things like that. The other major prohibition is life insurance.
Why those things specifically? Why collectibles and life insurance?
The intention is to stop people from using tax-sheltered retirement money to buy items they can enjoy or use today. If you buy a painting with your IRA, you could hang it on your wall, and you're getting an immediate benefit from the fund. Life insurance is out because it's fundamentally about providing a benefit to your family upon your death, which is different from the core purpose of providing for your own retirement.
So the asset itself is one hurdle, but the transaction around the asset, that's the bigger danger. Let's talk about prohibited transactions, especially the one about use. This is where the famous leaky toilet story comes from.
This is the most critical and, frankly, the least intuitive rule for the self-directed investor. It's the rule of strict separation. Once an asset is owned by the IRA trust, let's say it's a rental house, the IRA owner cannot receive or provide any immediate benefit from that investment.
Okay, let's walk through that rental property example because this is where the risk really hits home. I own a rental property through my self-directed IRA.
First, you can't live in it. That's an obvious personal benefit. Second, you can't rent it to any disqualified person. That means your kids, your spouse, your parents. That would also be a prohibited benefit.
That all makes sense.
Uh-huh.
But then the unexpected happens.
Yeah.
A pipe bursts, the toilet is flooding the bathroom. I'm handy, I can fix it myself in an hour.
You absolutely cannot. If you personally fix that leaky toilet, you are providing labor and service to the IRA trust. That labor is a service you would normally pay for, and by providing it for free, you are essentially making an unrecorded contribution or receiving a benefit by saving the IRA money. That is a prohibited transaction.
Wait, I can't even maintain my own asset.
The source material is very clear on this. The IRA must operate at arm's length. If the toilet needs fixing, the IRA, through its custodian, has to hire and pay a third-party plumber. If you, the IRA owner, fix it yourself, the entire IRA immediately loses its tax-sheltered status.
The entire IRA, not just the house.
The entire IRA. The whole value is treated as a taxable distribution in that year, and it's subject to penalties if you're under 59.5.
That is devastating. So you have to maintain absolute separation between yourself and the asset, even if it seems inefficient.
That's the price you pay for the tax shelter. The IRS is generous, but they demand absolute purity in return.
Okay, let's move to another complicated layer here.
Yeah.
Debt. Can an IRA borrow money to buy an asset, like getting a mortgage on that rental property?
Yes, an IRA can borrow money, but this triggers two really severe complications. First, the loan itself has to be a non-recourse loan.
What does non-recourse mean in practical terms?
It means the lender can only go after the asset that secures the loan, the real estate itself. You, the IRA owner, cannot personally guarantee the loan, and the lender can't have any claim on the other assets in your IRA. The loan has to stand completely on the value of the property. And that makes these loans riskier for lenders, so they're often harder to get.
And the second complication is that massive tax trap you mentioned earlier, UBIT.
UBIT, unrelated business income tax. This is the mechanism the IRS uses to look at debt-financed property inside an IRA and say, wait a minute, if you're leveraging this investment with borrowed money, you're acting like a business, and we are going to tax the profits that come from that debt.
So if I buy a $500,000 property using $250,000 of IRA cash and a $250,000 non-recourse loan, half the income from that property is debt financed.
Exactly. And the rental income that's attributable to that debt finance portion will be considered unrelated business taxable income. The IRA itself will be liable to pay UBIT on that income, often at very high trust tax rates.
So the takeaway on UBIT is, if I leverage my IRA to buy real estate, I've basically created a mini business inside my retirement fund, and the IRS is going to tax the business income from the debt, which could defeat the whole purpose of the tax deferral.
That is the perfect summary. It's a severe penalty designed to discourage competition between tax-exempt funds and regular taxable businesses. You can do it, but that tax benefit might just evaporate.
We've established the strict rules for getting money in and making it grow. Now let's talk about the even stricter rules for taking money out, which are all about deadlines and penalties.
The entire IRA system is built on the idea that these funds are locked away until retirement. The government gives you the tax break, but it's on the promise that you won't touch the money early.
What is that magic age when the penalty shield finally drops?
The penalty threshold is age 59.5. Unless you meet one of the specific hardship exceptions, any funds you pull out before this age are typically subject to a 10% early withdrawal penalty. And that's on top of being taxed as ordinary income if it's from a traditional IRA.
That's the when you can take it out rule.
Yeah.
But for owners of traditional accounts, there's also the when you must take it out rule.
That is the infamous required minimum distribution, or RMD, rule. Owners have to start taking distributions of at least the calculated minimum amount by April 1st of the year after the year they turn age 72. And that age has been slowly creeping up over time.
And if you miss that deadline, or you miscalculate the amount, I really want to emphasize how severe this penalty is.
It is the most devastating penalty in the entire IRA structure. If you don't take your RMD, the penalty is a staggering 50% of the amount that you should have distributed.
50%.
50. 50. This isn't a 10% slap on the wrist. It is the government taking half of the intended distribution because you failed to take it.
That's almost unbelievable. The IRS is absolutely determined to get its deferred tax revenue eventually.
Absolutely. And the RMD amount itself is calculated based on IRS life expectancy tables, which determine how much you need to take out each year to empty the account over your expected lifespan.
Although there is that special exception for older owners to satisfy their RMD without getting hit with the income tax.
Yes, the Qualified Charitable Distribution, or QCD. Once you are RMD age, your withdrawals are taxable unless those funds are paid directly from the IRA to a qualified charity. It's a crucial tool for high net worth people to meet their RMDs while also achieving their philanthropic goals, all without the RMD counting as taxable income.
Okay, now let's talk about those early withdrawal penalty exceptions. The lifelines, often called hardship withdrawals. They let you get money out before 59.5 without the penalty, though it might still be taxable.
There are 7 major categories. 2 are related to health. The first is for unreimbursed medical expenses, as long as they exceed 7.5% of your adjusted gross income. The second lets you withdraw penalty-free to cover medical insurance costs if you're unemployed.
And what about long-term or permanent inability to work?
A verifiable permanent disability, meaning you can't engage in any substantial gainful activity that allows penalty-free access. Also, distributions taken as a pre-calculated annuity stream called substantially equal periodic payments, or SEPPs, are exempt.
What about planning for the future? Or getting on the property ladder?
Penalty-free withdrawals are allowed for qualified higher education expenses for you, your kids, or even your grandkids. And there's a limited lifetime exception of up to $10,000 for distributions used to buy, build, or rebuild a first home.
And the last one.
Finally, if the IRS decides to levy the plan to satisfy your unpaid taxes, that distribution is also penalty-free.
Yeah, that is a surprisingly complex menu of exceptions. It seems like the government wants the money locked up, but they do recognize that life doesn't always go according to plan.
They do, but again, the fine print matters immensely. You have to meet the exact definition of qualified and disability to avoid that penalty.
Before we move on, we have to reiterate the huge flexibility of the Roth IRA when it comes to withdrawals, specifically regarding the money you put in, the basis.
This is the Roth's killer feature. Because you already paid tax on the contributed funds, the IRS lets you withdraw that original basis, the principal, at any time. Tax-free and penalty-free. You're just taking back money you already paid the tax on.
So the penalty only kicks in if you touch the earnings.
Right. The penalty only applies if you start withdrawing the earnings or growth portion of the account before 59.5, unless a hardship exception applies.
So the Roth acts like a second-tier emergency fund because the principal is so liquid.
It does. But there's a vital complication if you move money from a traditional IRA to a Roth. That's a conversion.
The 5-year rule.
Exactly. If you convert traditional funds into a Roth, those converted amounts have to stay in the Roth for a minimum of 5 years. If you withdraw the basis of those converted funds before that 5-year clock runs out, you'll face a penalty on the converted amount. It's a way to stop people from converting funds just to get immediate liquidity.
So even with the Roth, you've got to respect the clock. We've established the entry and exit rules. Now let's discuss the ultimate protection. The legal shielding of these assets from external disaster. The tax deferral is the main benefit of the IRA, but the secondary advantage, the strong legal framework that shields these assets from personal financial disaster, is often worth just as much. We're talking about bankruptcy protection.
And that protection has been substantially cemented by Supreme Court rulings. The federal foundation was confirmed in 2005. Which established that under federal bankruptcy law, a debtor could exempt their IRA from the bankruptcy estate as long as the amount was necessary for retirement.
Tripping necessity sounds like a lawyer's nightmare.
It was messy, but later that same year, Congress passed a key piece of legislation that dramatically increased the protection. This act exempted most IRAs, including Roths and rollovers, up to a massive inflation-adjusted cap, and the debtor didn't have to prove necessity.
So protection became automatic up to a really high amount.
Correct. The cap is well into the 7 figures now. But here's the most important legal protection. Funds that are rolled over from most employer plans, like 401ks, into an IRA, are entirely exempt from the bankruptcy estate. There's no cap.
That is a huge takeaway. If you leave a job, rolling your 401k directly into an IRA preserves the highest possible level of federal bankruptcy protection.
Absolutely. However, as always, there is a giant loophole, and it ties back to our earlier discussion on prohibited transactions. If an IRA engages in a prohibited transaction, it immediately loses its tax status.
And if it loses its tax status, it's no longer considered a legitimate retirement fund.
Precisely, which
Right.
means it loses its bankruptcy protection. So if that self-directed IRA owner uses their IRA-owned house for a 2-week vacation, committing a prohibited transaction, they might not just face a tax bill. They could lose the entire asset in a subsequent bankruptcy. Compliance isn't just about taxes, it's about existential asset protection.
Now we get to a vulnerability that affects estate planning. Inherited IRAs. This is where the Supreme Court carved out a major hole in the federal shield back in 2014.
This is a vital point that so many people miss. In the 2014 ruling, the Supreme Court stated that funds in an inherited IRA, specifically one inherited by a non-spouse, do not qualify as retirement funds under the federal bankruptcy exemption statute.
That's a huge shift. Why the difference between a spouse inheriting it and a non-spouse?
The court's reasoning was that once an IRA is inherited by a non-spouse, the beneficiary can access the funds relatively easily, and they can't contribute to the account anymore. So the funds are no longer set aside for the beneficiary's retirement. They're an investment asset available for consumption. And as an available asset, they are fair game for creditors in a bankruptcy.
So the federal shield that protected the original owner's million-dollar IRA just evaporates the moment it passes to a non-spouse child, leaving the assets totally exposed.
That is the grim reality at the federal level. At that point, you just have to hope that your state law provides some protection.
Which brings us to general creditor protection, outside of bankruptcy. We saw that many states have laws prohibiting the seizure of IRA assets in standard lawsuits.
Many do, but the level of protection is all over the place. Nevada, for example, is very protective. It exempts IRA assets up to $500,000, but other states, like California, have these highly subjective statutes.
How does California determine protection?
The California statute only protects the amount necessary to provide for the support of the judgment debtor when the judgment debtor retires. So a court has to look at the debtor's age, career, other savings, future earning potential.
So a 35-year-old high-earning engineer facing a lawsuit might get very little protection because the court assumes they can just rebuild their savings later.
Exactly. It's judged case by case, and it often provides less defense to younger, more highly skilled debtors.
And even where state protection exists, it's not absolute.
No. It typically collapses in cases of divorce, failure to pay taxes, or judgments related to fraud.
Finally, let's touch on that temporary borrowing mechanism, the 60-day indirect rollover. This is a very niche tool for short-term liquidity.
It's the one exception to the no borrowing rule. An IRA owner is allowed to take a distribution from their account, and it's tax and penalty-free at that moment as long as the owner redeposits the entire amount into another IRA within 60 calendar days.
So I can use the IRA money for 2 months, interest-free, if I return it perfectly on time.
That's the idea. It's an indirect rollover, but you can only do this once in a calendar year. And if you go past that 60-day window, or if you don't deposit the full amount, the whole transaction is retroactively treated as a permanent early withdrawal.
Which means taxes and potentially the 10% early withdrawal penalty. That's a massive risk.
It's a high-wire act. It's mostly used when switching custodians or solving a very short-term cash crunch. It really just reinforces the idea that the IRA is a permanent savings vehicle, not a personal bank account.
We've covered the entry, growth, exit, and legal protection of the IRA. Now let's discuss what happens at the end of the owner's journey. Inheritance.
The inheritance rules are arguably the most confusing part of the entire structure, especially with the recent legislative changes. The treatment of the assets depends entirely on whether the beneficiary is a spouse or a non-spouse.
Let's start with the spouse. Who gets the most flexibility and the biggest advantage?
A surviving spouse has several great options. The most common choice is to treat the IRA as their own. This is basically a continuation of the tax deferral. The spouse can keep making contributions, they can name new beneficiaries, and crucially, they don't have to start required minimum distributions until they reach the RMD age.
They can also just roll the funds over into another plan.
Yes, they can roll the funds into another plan and take distributions as a beneficiary based on their own life expectancy. This gives them a much slower distribution schedule than the rules for non-spouse heirs. Or, they can take a lump sum, but that comes with a high immediate tax cost if it's a traditional IRA.
And what about the option to disclaim?
They can disclaim up to 100% of the assets. This is usually done for sophisticated estate planning. It lets the next beneficiaries, like adult children, inherit the funds right away. It's useful if the surviving spouse has plenty of other resources and wants to bypass their own estate.
Okay, now the situation changes dramatically for a non-spouse beneficiary, like a child or a friend. They are explicitly prohibited from treating the IRA as their own.
Correct. For non-spouse beneficiaries, the standard rule is now the 10-year rule. This says the beneficiary has to empty the entire IRA account within 10 years of the original owner's death. It's designed to accelerate taxation and stop multi-generational stretching of the tax deferral.
The 10-year rule is a major shift from how things used to be. The old stretch option, where they could take distributions over their own life expectancy, that's largely on now.
It's been severely curtailed. It forces distribution and taxation much, much sooner. However, there are some important exceptions for certain eligible designated beneficiaries who can still use a longer schedule.
Who qualifies for that?
First, minor children of the decedent. They can take distributions based on their own life expectancy, which is a very slow schedule, but only until they reach the age majority, usually 21. Once they hit 21, the 10-year rule kicks in, and they have to get everything out by the 10th year after that 21st birthday.
And what about beneficiaries who were dependent on the deceased?
Beneficiaries who are chronically ill or permanently disabled, no matter their age, can use their own life expectancy to stretch out the distributions. This is critical for providing long-term support. The final exception allows the life expectancy schedule for beneficiaries who are not more than 10 years younger than the decedent.
If an inherited IRA has multiple non-spouse beneficiaries, how do the RMDs work then?
If the inherited IRA is kept as one undivided account, yes, the distributions are based on the age of the oldest beneficiary, which forces everyone onto the shortest timeline. But beneficiaries are usually allowed to split the inherited IRA into separate accounts. If they do that, then the RMD rules apply separately to each account based on that individual heir status.
Before we wrap this up, let's briefly touch on the frustration of double taxation that can happen when IRAs hold certain international assets.
This is a really frustrating loophole that affects sophisticated investors. Double taxation happens when an IRA holds foreign stocks that pay dividends. Those dividends get taxed by the foreign country, say, Canada, at the source. But because the IRA is a tax-advantaged trust, the IRS generally doesn't recognize this foreign tax as a creditable deduction for the IRA.
So the money gets taxed abroad, and then it gets taxed again by the U.S. when it's eventually pulled out of a traditional IRA.
Exactly. It creates a situation where the foreign tax credit that a normal brokerage account would get just isn't available, and it leads to all these arguments about whether this violates international tax treaties.
And finally, for some global context, this elaborate U.S. system isn't unique, is it? Many developed countries have similar mechanisms.
They do. It reflects a global policy goal to encourage private retirement saving. Canada has the RRSP, which is like the traditional IRA, and the TFSA, which mirrors the Roth. The UK has the individual savings account, or ISA. Even Australia's compulsory superannuation system, which is a very different structure, is aiming at the same goal.
It's clear the U.S. IRA is part of a global movement, but the specifics of its strict separation rules and self-directed flexibility seem uniquely American. Now, let's ground this whole conversation in reality by looking at the hard data, which paints a picture of extreme disparity.
The statistics are, I think, the most jarring part of this whole deep dive. They show that the IRA system is effectively serving two vastly different populations, one that uses it for massive tax-free wealth accumulation, and the other, the majority, that is struggling just to meet basic retirement goals.
Let's start with that classic split between the average and the median balance. We're using 2008 data from the Employee Benefit Research Institute here.
The data showed the average individual IRA balance was nearly $70,000, but the median individual IRA balance was just over $20,000.
An almost $50,000 gap. That is a huge difference.
It's a perfect illustration of positive skew. The average is pulled way, way higher than the median, the true midpoint, by a very small number of people who hold accounts worth hundreds of thousands or even millions of dollars. The median is a much more accurate reflection of the typical saver's reality.
But what really changes the perception of the IRA is how the money gets in. The data on rollovers versus contributions is stunning.
This is probably the most defining statistical characteristic of the system. The IRA, statistically, is overwhelmingly a wealth preservation mechanism. The vast majority of dollars that enter IRAs come from rollovers, transfers from old 401ks when people change jobs, not from new annual contributions of earned income.
And the data quantifies this staggering difference.
Rollovers add over 10 times as much money to IRAs every year than new contributions do. This suggests the IRA's primary function isn't necessarily encouraging the average worker to save $7,000 from scratch each year, but rather serving as a holding tank for large, accumulated sums that are transferred from workplace plans.
So it's more of an administrative vessel for job changers, not a primary savings vehicle for a worker just starting out.
Exactly. And while many rollovers are small, a significant portion are massive. Over 20% of them exceed $100,000, injecting these huge pre-tax sums into the system.
And when we look at who does contribute new money, the effort is really concentrated.
Of those who actively contribute to their IRA in a given year, something like 40% contributed the maximum allowable amount. This shows that the people engaging with the system are highly disciplined and focused on maximizing that tax benefit, but they are a distinct minority of the total account holders.
Let's look at the sheer scale of the system now, using that 2011 GAO data. The total value is just enormous.
In 2011, 43 million taxpayers held IRAs, totaling a fair market value of $5.2 trillion. And the cost to the federal government in foregone tax revenue is estimated at over $17 billion a year. That's the price of the incentive to shelter those assets.
Within that $5.2 trillion, the vast majority, 98.5%, have balances of $1 million or less. But let's zero in on that tiny sliver that drives the skew, the mega IRA phenomenon.
This is where that self-directed IRA discussion from earlier comes back to life. The data shows incredible wealth concentration at the very top. Very few taxpayers have balances over $5 million. In 2011, there were only about 7,900 taxpayers in that $5 to $10 million range.
And at the absolute extreme end, the numbers are just shocking.
There were only 314 taxpayers who held aggregated balances over $25 million. And the source material highlights the most famous example of this, Peter Thiel, who reportedly leveraged the self-directed Roth IRA to amass a value of $5 billion by investing in startups like PayPal and Palantir very early on.
So he used the Roth structure to invest in private company stock, those alternative investments we talked about. And when those companies went public, the exponential growth was entirely tax-free.
That is the mechanism. It illustrates that for a tiny fraction of the ultra-wealthy, the IRA transforms from a middle-class retirement vehicle into an engine for generational tax-free wealth accumulation. And that has led policy critics to argue that the tax benefits should be capped or limited to prevent such extreme outcomes.
But that concentration of wealth is only half the story. Let's pivot sharply to the counterpoint, the American retirement crisis.
The reality for the typical worker is just stark. According to the research, 45% of working Americans do not own any retirement account assets at all. No IRA, no 401k, nothing.
45%. That is nearly half of the workforce completely uncovered. And for those who do save, the balances are just perilously low.
The median retirement account balance, and that's combining IRAs and employer plans, is only $2,500 for all working-age households. Even for households that are nearing retirement, that median balance only crawls up to $14,500.
And looking at 2020 data, half of American adults combined had less than $6,500 in their IRAs and defined contribution plans. That is the overwhelming context against which those multi-million-dollar mega IRAs are built.
It creates a huge ethical and policy question about the effectiveness and fairness of the system. It was designed to promote savings, but it appears to be heavily utilized as a wealth preservation tool for those who already have high capital and access to these complex self-directed strategies. #outro. If we summarize the key insights from this deep dive, I think it's that navigating the IRA requires precision. The primary choice is the tax structure, right? Traditional for the upfront break, Roth for the tax-free exit, and that flexible principle.
Right.
The second necessity is understanding the strict rules, particularly that severe risk of prohibited transactions in self-directed accounts, where even a minor involvement by the owner can completely void the entire tax shelter.
And finally, the legal landscape is just full of these potential pitfalls. While federal bankruptcy protection is robust, the moment an IRA is inherited by a non-spouse, that protection is largely stripped away. And that creates a crucial vulnerability for estate planning. It really feels like this system has evolved from a simple savings tool into this complex financial structure with highly divergent outcomes, heavily favoring those who already have significant wealth to roll over.
Knowing these nuances, from the 50% RMD penalty to the UBIT trap, it's essential if you want to use the IRA effectively and just avoid the costly surprises that are hidden in the fine print.
Let's leave you with this final provocative thought, connecting that statistical reality with the purpose of the IRA. If rollovers overwhelm new contributions by a factor of 10, Does the IRA function more effectively as a wealth preservation mechanism for those changing jobs than as a primary savings vehicle for the average worker who's starting from scratch and who desperately needs that median balance to climb? So what does this all mean? We'll let you decide on this deep dive.